In this video, we're going to talk about 3 risks that you absolutely must know before moving forward and before placing your first wheel trade. If you're into personal finance and investing, hit the subscribe button, hit the notification bell. You'll get alerted to whenever we put out new videos. We have new videos weekly. Okay, let's dive right in here with a quick recap of the wheel strategy. And I'll put a link in the description below. Check that out if you're looking for a more detailed and nuanced view of the wheel trade. It goes into all of the specifics on how to actually use the wheel strategy to create passive income with selling options and selling puts and covered calls. So check that out if you're looking for a more detailed overview of the wheel strategy. Okay, and now let's jump into that quick recap of the wheel strategy. So we start out by selling a put option. For this, we collect a premium. We collect money upfront for selling that put option. And if our stock stays above the strike price at the time of expiration, we'll sell another put option. So we keep repeating this first step of the wheel strategy until our stock price closes below the strike price at the time of expiration. And when that happens, we buy 100 shares of stock at the strike price. We buy it at the strike price, not the price the stock is actually trading for. That's an important distinction here. So we'll buy 100 shares at the strike price, and then we immediately sell a call option. And then if the stock price at the time of expiration closes below the strike price, we sell another call option. And we repeat this process until the stock price closes above the strike price at the time of expiration. And then we're forced to sell our 100 shares at the strike price. And that's important here again, we're forced to sell the 100 shares at the strike price. And then what we do is we start the process all over again from the top. We sell another put option and just go through the steps again. And then from there what we do is we smash that like button. It really helps out the channel. If you're liking the video so far, hit the like button. Thanks a lot. Okay, so now that we've covered the wheel strategy and gone over the basics of it, let's go through a good wheel trade, a trade where everything goes right for us. So this is just an example here. I'm not using an actual stock, I'm not using actual prices, but this is going to be an example here. Okay, in this example here, let's assume that the stock price is $22 a share and that we're selling a put with a strike price of 20. So if the stock closes below 20, that's when we would have to buy stock. And for selling this put option, we're going to get paid $125. So right now, we've collected $125 and we don't have any stock at all. If the stock stays above $20 a share, we'll repeat this process again. Okay, and in the spirit of everything going in our favor, let's assume that the stock price comes down to $21.50, so it stays above $20 a share, and we're going to sell another put. We're selling another put, we're collecting another $125 up front. That brings us to a total of $250 that we've collected so far. So we're in good shape here. We've collected $250, and as long as the stock stays above $20 per share, we don't have to buy the stock. But let's assume here that the stock actually goes below $20 per share at this point here. So we're assuming that the stock closes at $19.75 at the time of expiration, and we're gonna have to buy the stock at the strike price that we sold it for. So we're gonna have to buy the stock at $20 a share, which means that we're going to pay $2,000 to buy 100 shares of stock. So at this point now, we have 100 shares of stock, and we're going to immediately sell a call option here. The call option that we're going to sell, let's assume that the strike price that we're selling it at is $21 a share. We're taking in $100 of premium for selling that call option, and that brings down our cash outflows from $17.50 to $16.50 once we take in that $100. Okay, everything's going in our favor in example. So the price was $19.75 when we sold the call option. We have 100 shares of stock. Let's assume that when this option expires, that the stock price goes up and closes above $21 a share. So we're gonna now have to sell our 100 shares of stock for $2,100 at $21 a share, the strike price that we sold our call option for. So we're taking in $2,100 here. And this brings us to a profit of $450 for the entirety of the wheel trade here. And that is great. We don't have any stock anymore, and we have an extra $450 in our account from before we did this wheel trade. This one went really well. All right, let's go through exactly how we get to the $450 worth of profit for this wheel trade. First, we started out with selling a put option. We collected $125 for that put option. We then sold another put option and collected another $125. From there, we ended up having to buy the stock. And we bought the stock for $2,000, 100 shares at $20 a share, so the total was $2,000 that we paid for the stock. From that point, we sold a call option and collected $100 for it. Now, the last portion here was that we ended up selling the 100 shares of stock for $2,100 total. So now all of this comes to a grand total of $450 worth of profit for this wheel trade. This is a good one. Now we made $450 and that's great. And you might be thinking, let's just let the cash roll in here. Let's do wheel trades and just let the cash roll in. But we really need to think about the risks associated with the wheel trade before getting into it. There are 3 risks that I want to talk about today, and they're really important to understand before you move forward and before you start making wheel trades of your own. Now, the first risk here is that you could have a losing trade. I know that people say that the wheel strategy is risk-free and it's a guaranteed profit, and that's just not true. You could definitely have a losing trade, and we can go through an example of how that happens right here. So we're going to start out the same exact way that we did with the good trade. We're going to sell a put option with a strike price of $20, and we're going to sell that put option for $125. We're collecting that $125 of premium up front, and then we're going to wait to see what happens to the stock price. And here's where things start to differ from the good trade. Here's where the stock price goes down from $22 a share to $14 a share. And you need to pay $2,000 for 100 shares of stock. So you need to pay $20 a share because that's the strike price that you sold the put for to collect the $125. And you need to pay $2,000 now for a stock that's only worth $14 a share. So it's only worth $1,400. Now, this is a decent hole to have to dig out of here, and this is kind of what a losing trade starts to look like, where you sell a put option and the stock immediately plummets and you're now looking at a pretty substantial loss. And this can definitely happen. This can happen if the company announces earnings that aren't good. It could happen just if the stock market goes down overall and the stock goes down with the market. It could happen for any number of reasons. It's not very likely that this is going to happen, but it can definitely happen. And if this happens, you have a few options. We can talk through the options here. And the first one is that you can just sell the stock. You could sell the stock for $14 a share. You'll collect $1,400 and you can be done with the trade. So you'll collect $1,400. That would make the overall loss $475 for the trade. So in the first scenario, we came out with a profit of $450. Here in this losing trade scenario, we're potentially taking a loss of $475 if we sell the stock right away. Another option that you have, if the stock just plummets after you sold the put option, is that you can just hold the stock and hope that it comes back up in price. And if it's a stock that you believe in, this might be a very viable option for you to move forward with, that you just hold the stock and wait for the price to come back up, for you to sell it at break even, for you to sell it at a slight loss, a slight profit. It's kind of, up to you at that point how you want to handle it, but you can wait for the stock to, hopefully come back up. And if you wait for it to come back up and it does, great. And if not, that's also a situation that you just need to understand may happen. And if you're going to hold the stock, there are, some risks associated with that. The next thing that you can do is you can sell call options that are for strike prices that are really high, that are for $20 or $21 a share, and you're not going to collect all that much premium, but you'll still collect a little bit of premium every month. And that's a good way to offset some of the losses that you currently have on paper. Another option that you have is that you could sell call options with a strike price that is closer to where the stock is currently trading at. So if the stock is at $14, you could sell a call option with a strike price of $15 or $16 a share. And if you do this, you'll collect more premium than if you were selling a call option for $20 or $21 a share. But you're also taking on the risk that the stock goes up past your strike price, and then you need to sell the stock at the strike price. So you can take an overall loss on the trade because the stock price goes up and you're forced to sell your stock at the strike price. So there are a couple things to consider here. There's no one size fits all strategy here when the stock price plummets after selling the put option. It's kind of a situation where you need to consider what you think is best for you to do now that the stock price is substantially lower than it was trading at when you sold the put option. And something that I talk about in my more detailed wheel strategy video is that you need to really believe in the stock that you're using for the wheel strategy. Exactly because of this reason. If the stock price comes down substantially, you want to make sure that it's a stock that you believe in, that you think has an opportunity to rebound. And if you don't believe in the stock, it makes this situation a lot harder to deal with. The second risk here is missing out on a big move. And this is not a risk where you're going to lose money, but if the stock price goes up very substantially, if it goes up 50%, you're not going to see that level of profit from using the wheel strategy. Let's go into an example here so I can show you exactly what I mean. All right, so we're going to start out the same way that we started with the other trades. We're going to sell a put option. The stock is $22 per share. We're going to sell a put option with a strike price of $20 for $125 of premium. So from there, let's assume that the stock price comes down to $19.75, and then we need to buy that 100 shares of stock for $2,000, our strike price of $20 a share times 100 shares is our $2,000 that we're paying for the stock. All right, so once we buy stock and we're using the strategy, you know what we do. We immediately sell a call option, and we're gonna sell a call option here, and we're gonna take in $100 for selling a call option with a $21 strike price. So if the stock goes above $21 a share, we're gonna be forced to sell the stock for $2,100 or $21 a share. All right, so I think that you know what's coming here. The stock is going to just jump on a rocket ship and go right to the moon to $30 a share. But you don't get $30 a share when you sell the stock. You're now going to have to sell your stock for $21 a share. That's the strike price that we sold the call option for, and you're gonna sell your 100 shares for $21 a share or $2,100, not $30 a share. So you miss out on this big move because you sold the call option. And that's a risk that we just have to take if we're implementing the wheel strategy. You may miss out on big moves, and it's gonna happen. It's gonna hurt a bit to see the stock go just flying and not be able to participate on that big move. So even though we're not participating on the big move and we're missing out on that really big profit, we're still gonna make $325 in profit on this trade. We're just missing out on the difference between $21 a share and $30 a share. The next risk that I want to talk about here is the tax rate. And I'm just a dude on the internet. Don't take tax advice from me, but I want to share with you some thoughts around tax rates. The difference in the tax rate between short-term capital gains and long-term capital gains is about 10 to 25%, depending upon which tax bracket you're in. And that is huge. That is a big difference in terms of the amount of tax that you need to pay on your gains. So the wheel strategy, you're gonna run into a lot of situations where you have short-term capital gains and taxed at a higher rate than if you just bought stock, held it for a year or two, and sold that stock at a profit. In that case, you would have long-term capital gains, and you would be taxed at a substantially lower rate for those long-term capital gains than for the short-term capital gains that are derived through the wheel strategy. So again, I'm not a tax advisor. Don't take tax advice from me. Look into this on your own. Call a CPA. I'm just a guy on the internet. Don't take tax advice from me. But this is important. It's an important consideration. Look into the tax rate and the difference between short-term capital gains and long-term capital gains. And here's a recap of our 3 risks here. Our first, having a losing trade where the stock just plummets after you sell the put option. And the second risk, missing out on that big move after you sell a call option and you don't get to participate on the massive upside that the stock is experiencing. And the third risk is around tax rate and being taxed at a substantially higher rate than if you were just buying and holding stocks for a long period of time before selling them for a gain. Okay, so now that you know these 3 risks, let me know in the comments, are you still going to use the wheel strategy, or did this deter you from the wheel strategy? Let me know, and also let me know if you have any questions. Happy to answer any questions. I read all the comments, so let me know if you have any questions in the comments. All right, I'll see you in the next video.